to finance your next investment property? Well, we have got you covered. Today, I'm going to dive into DSCR and ways to secure the best deal on your loans. Thanks for joining us. My name is Thomas at Easy Street Capital, and today I want to give you a brief overview, if you didn't get a chance to watch our part 1 video on how to secure the best terms for your DSCR loan. So the rates and terms are primarily driven by 3 main metrics that we overview in this video, linked here. That's the loan to value ratio, or LTV. This is basically the ratio of your loan to the value of the property itself. Second metric is the debt service coverage ratio, or DSCR ratio. This is basically the ratio of the property's rental income to its PITIA expenses. And then the third metric is going to be FICO, or your personal credit score. While your rate and your terms are mainly driven by these 3 factors, there are certainly other components that play a role in determining what your rate and terms will be for a DSCR loan. So as an investor, you of course make it your goal to leverage as many factors as possible to ensure that you get the best rate and terms. So one of the other things that factors into these sort of rates and terms are prepayment penalties. So prepayment penalties, if you're not familiar, are basically fees that you have to pay if you end up paying your loan off early. And they're commonly included in these DSCR loans, which of course are used for real estate investments, not owner-occupied properties. So these penalties are a good way for lenders to give borrowers essentially lower interest rates. Now you say, now how do they do this? Well, basically what they do is they take the DSCR loans and they actually bundle them together and sell them to investors who want predictable cash flows. So if too many borrowers pay off their loans early, it can disrupt these cash flows as the loans sort of move up the food chain. So by agreeing to this thing called a prepayment penalty, borrowers can get lower interest rates with these penalties for paying off the loan early. So what's kind of the structure of prepayment penalties? Well, it can vary, but a really common option is called the step-down structure. So this essentially means that the penalty decreases as time goes on. So for example, one of these common step-down structures is called the 5-4-3-2-1 structure. So it's a little confusing, but here's basically what it means. So the penalty is 5% if you pay off the loan within the first year of its origination, then 4% if you pay it off in the second year, and so on and so forth. So, do these penalties really have any upsides? Well, they kind of do. If you're a long-term investor and you plan to hold on to your properties for a while, then prepayment penalties really don't have an impact on you other than lowering your rate. Now, if you're not planning to sell or refinance within the penalty period, agreeing to a prepayment penalty, it's really a good choice. Even if you want to refinance and the interest rates do decrease, the nice thing with prepayment penalties is that they're usually small enough that it's still kind of economically smart to refinance despite having the penalty in place. And plus, any potential savings from lower rates and increased property value usually outweighs this penalty amount. Now, for real estate investors, if you're using DSCR loans, another option to consider as sort of lever other than this prepayment penalty is an adjustable rate mortgage, which is also known as an ARM, ARM. Now, ARMs can be pretty tricky, so it's pretty important to understand their structure properly and really do your research on market rates and projections. So a lot of people know ARMs for their role in contributing to the 2008 financial crisis. But ARMs for DSCR loans today really have an important difference and various differences truly from the ones that contributed to 2008. So ARM DSCR loans, they're still 30-year mortgage loans, but the ARM term refers to the initial fixed rate period rather than the full term. So what this means is, unlike earlier ARMs that contributed to 2008, they kind of quickly started fluctuating, their rate very soon after their origination. The DSCR ARMs, they're not like this. They're more like sort of a hybrid product. So it's only after an initial period of a fixed interest rate, this is usually 5 to 7 years, that the interest rate begins to fluctuate. So, how do we kind of look at ARM terms? Well, they're really expressed as 2 numbers separated by a slash, such as 5/1 or 7/6. So the first number in this sort of coding indicates what that initial fixed rate period in years is going to be. And then the second number represents the frequency of rate adjustments after that fixed period, and this is in months. So it can be a little bit confusing if you're just learning it, but here, a simple trick to remember is that the first number is in years and the second number is in months. So ARM DSCR loans, they really have various provisions to determine what the interest rate is after this initial fixed rate period. So the rate typically consists of a predetermined margin, and then on top of that, an index number, such as the secured overnight financing rate, also known as the SOFR, or the London Interbank Offered Rate, also known as the LIBOR. The floating rate usually has a floor, which is usually this initial fixed rate, and a ceiling, which is usually the initial fixed rate plus 5 or 6%, along with periodic rate adjustment caps to prevent some sort of sudden rate shock or huge significant changes in the rate. Okay, so we know all this. Now, how do you take advantage of these ARM options as a DSCR borrower? Well, first, it's important to know that ARM rates are generally lower than those of a 30-year fixed rate loan. Kind of makes sense. Now, currently, ARM rates, they're about 12.5 to about 38 basis points lower than their fixed rate counterparts. So, knowing this, you basically need to think about and even forecast where you think rates will be in about 5 years when the rate starts adjusting. Now, if you believe that the rates are going to be lower or they're going to be stable within this 5-year time frame from now, then the ARM might be the right option for you. Tying back, to the first part of this video, it's also good to know that prepayment penalties for DSCR loans typically don't last more than 5 years. So you're probably not going to be penalized when you're refinancing after the ARM's initial 5 or 7-year fixed rate period. To kind of sum it up, you need to consider your risk tolerance, your investment plans, and really the general market and economic outlook before deciding on an ARM. So that wraps up this part 2 of how to secure the best rates on the DSCR loan. If you have any questions, feel free, please drop them in the comments below. And as always, be sure to like and subscribe to Easy Street Capital right here on YouTube for more industry insights.